And our next guest sees even more gains overseas in the year ahead. You see that little outperformance there among non-U.S. stocks. Not bad. Let's bring in Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab for International. Jeff, it's great to talk to you. I mean, we and others have talked about how you had the makings for global stock outperformance for a while. Valuation looked better overseas and all the rest. Do you think that there's traction, perhaps, in the international outperformance now?
I think we've turned the corner, and usually for an entire cycle you get one or the other outperforming, international or the U.S., and we had that for the last cycle. I think the tide has turned, and I think we are likely to see international outperformance continue next year. They tend to possess more of the characteristics like high dividend yields and lower price to cash flow ratios that have contributed to outperformance within and across sectors and countries this year. Earnings growth, we know, is stronger outside the U.S. and expected to remain so next year. And you combine that with lower valuations and this turning, and it's maybe more behavioral than fundamental. As you end a cycle, whatever's outperformed tends to be stretched in terms of valuations and expectations. And as we go through this kind of a correction, we reset the clock and we get outperformance by what were the laggards, which are now the international stocks. I think if we can get a pause or a reversal in the sharp rise of the dollar that characterized much of this year, it might even be more pronounced.
Well, we've certainly seen at least the makings of that reversal in the dollar, I suppose. Does it have to deepen in order for the international outperformance to really continue here? I mean, we're well off the highs in the dollar, but still, of course, up year to date.
Yeah, no, I don't think we need the dollar. I think it would be a help. I think the other factors are more important. This year, in both down and up markets, we saw those high dividend payers and those low price to cash flow stocks outperforming across sectors. You even saw it in tech. The highest dividend payers in tech were the better performers, right? And that's generally true outside the U.S. They tend to have higher dividend yields. We know they tend to have lower valuations. These are quality factors, and I think those are going to continue to be embraced next year. I think we're in a market of higher volatility. Now, it's been more to the upside here lately, but over the last 6 months, we've seen markets move up or down 5% every month. And I think that volatility could continue in the first half of next year. So sticking with those themes that have worked here over the last 6 months should pay off, and that points to international stocks.
So what I'm hearing you lay out here, Jeff, is that the characteristics that should work in an environment we're facing are more prevalent in global markets, right? It's sort of the flip side of, the U.S. market's outperforming because we have all the big growth in tech stocks.
Yeah, that's exactly right. It's exactly the flip side of that. They have a lot more energy, a lot more financials, a lot more of these higher dividend payers and low price to free cash flow companies. It's an abundance. In fact, I would say, if you look at it, it's like 70% of the lower price to cash flow companies are located in the EFI index, only 30% of the global companies in the U.S. So yeah, it's a flip. It's an inverse of what worked for the last cycle usually doesn't work in the next cycle. We're, I think, about to start that next cycle.
Where does the China element play into it, either as a macro driver or just the fact that, this is a market that really had been sidelined for much of the move in U.S. stocks up into this year? It's up off the lows, but still seems like it's a deep underperformer on a multi-year basis.
Yeah, it's a big risk to 2023, upside and downside. Certainly China's return to the global economic picture as they shut down their zero COVID protocols means better growth for the globe. But at the same time, it could restoke inflation. And we know, one of the things that has been driving the market higher is the idea that central banks may be done early next year. And if China's reopening brings about a resurgence in demand for goods and commodities that pushes up prices again, well, central banks may not be done. And that could weigh on cyclicals, and that's one of the Achilles heels of international stocks. They do tend to have more cyclicals than U.S. equities, and so if we renew that downward pressure and those renewed concerns about a deeper recession, international could bear the brunt of that.
Yeah. Okay. So China again, at least the economy, there may be a swing factor to a degree into next year. Jeff, thanks very much. Appreciate your perspective.
Thanks, Mike. Great to be on.